webinar in relation to the tax issues facing SMEs expanding overseas. In today's webinar, I'm going to be looking at two areas: trading and profit management and finance and cash management. Under the broad area of trading and profit management, there could be many areas for consideration. It will depend on the nature of the business which will be the most important. Key aspects to consider will often include related party transactions and transfer pricing, anti-avoidance legislation, and global mobility and employee tax issues. The term transfer pricing relates to the pricing of cross-border, intra-firm transactions between connected parties. It can include tangible and intangible property, services, loans, and other financing. The transfer pricing legislation is basically designed to prevent connected parties from shifting profits from one entity to another. The UK legislation basically does this by providing that transactions should be undertaken on an arm's length basis. In the UK, the transfer pricing legislation will only allow an adjustment to either reduce a loss or increase a taxable profit, and not vice versa. The UK legislation applies to all UK taxpayers, which will include UK branches or permanent establishments of overseas companies. Transfer pricing can also apply to transactions between parties where they are both in the UK. For transfer pricing purposes, the definition of connected is the one found within section 1122 of CTA 2010. You can look at the definition yourself should you ever need to, but broadly, a company will be connected with another company if they're under common control. There is an exemption from applying transfer pricing rules for the vast majority of transactions carried out by businesses which are classified either as small or medium-sized enterprises. An entity will qualify as either small or medium if it's below the employee headcount ceiling for that class, as shown in the table, and also meets one or both of the financial limits. Where an entity is a member of a group or has an associated entity, then the limits will apply to the whole group and not the individual entity. There is an exception to the SME exemption, and this will apply where a business has transactions with a related business in a non-qualifying territory. The legislation defines a qualifying and non-qualifying territory, and the definition is within section 173 of TIOPA. A qualifying territory will be one which has a double taxation agreement with the UK, which includes a non-discrimination provision. In their international manual, HMRC has published a list of the double taxation treaties that they regard as having an appropriate article. Unfortunately, this does not seem to have been updated since 2011, and this does mean that it is sometimes necessary to go back to the definition and consider the provisions of a treaty. For example, recently I was advising a client with business activities in the UK and Dubai. United Arab Emirates is not on the HMRC list. However, a double taxation agreement between the UK and the UAE entered into force in December 2016 to take effect with respect to taxes applicable from the 1st of January 2017. Having reviewed the double taxation agreement, this does include a non-discrimination clause based upon the OECD model treaty clause. On that basis, you would have to conclude that the UAE would be a qualifying territory for this purpose. Further, there is an exception to the SME exemption for medium-sized enterprises who have been issued with a transfer pricing notice. HMRC can issue a transfer pricing notice requiring a medium-sized company to apply transfer pricing rules, but this can only be issued once a notice of inquiry into a return of the company for the relevant period has been issued. There is no ability for transfer pricing notices to be issued to small companies. There are some other anti-avoidance rules which may need to be taken into account in other specific circumstances. Finance Act 2014 introduced a new section 1305A to CTA 2009, and this is to counteract a transfer of profits between companies. The legislation is aimed at transfers of profit using derivative contracts or similar instruments. Basically, these would fall outside the scope of the main anti-avoidance legislation. So hopefully these would only be applicable in very limited circumstances, as HMRC have confirmed that it will not seek to apply Section 1305A to transfer pricing situations, except where transactions lack commercial substance or are obviously artificial. The diverted profits tax took effect from the 1st of April 2015 and applies a tax rate of 25% in place of the normal corporation tax rate, so that's currently 19%, to profits arising from arrangements which seek to avoid a UK permanent establishment, but where there is activity in the UK in connection with the supply of goods and services by a non-UK resident company. It will also apply to arrangements that seek to divert profits from the UK which lack economic substance. When first expanding to have a presence overseas, one of the first issues to consider is likely to be what type of employment arrangements best fit the needs of the business. Should a senior UK employee be sent on a temporary assignment for a limited period? Will one or more employees be posted abroad for a period of months or even years? Do you want to rely on existing UK employees, or is it better to recruit locally? The best approach will differ from case to case, and it needs to take into account the extent of the company's interests overseas and the rules and regulations that apply in that particular jurisdiction. Initially, it's often easier to use UK employees. However, at a certain stage, it will become important to get the right people in the right jobs. Host country employees will have key insights into the local market, cultures, etc., whilst UK employees are likely to have a better understanding of the business and its objectives. A mix of local and expat talent will often be the best way forward. In terms of the scope for today, we will look at some of the main issues to consider when using UK employees or host country employees. Sending UK employees overseas can raise many challenges for SMEs. There are a myriad of different international tax systems, and an individual's liability to income tax will be determined by local tax law and/or the tax treaty between the UK and the relevant country. Most countries tax employment income by reference to the individual's residence status and the place that the employee's duties are performed. The effect of this is that a UK employee working abroad may be liable to pay tax on their earnings in the foreign country because that's where the duties are performed, as well as in the UK because they are UK tax resident. Hence, the same income can potentially be taxed twice. Double taxation is eliminated either by the tax credit rules in the UK legislation or the provisions of the relevant tax treaty. Many tax treaties follow the OECD model, and the aim is to eliminate double taxation of income or gains which arise in one state belonging to a resident of the other. This is normally achieved by overruling the taxing rights that each treaty partner has under domestic law and setting out which state will have primary taxing rights over a particular income. In many overseas contract situations where an employee is abroad for less than 183 days, no overseas tax is ultimately found to be due. This is usually because such employees are protected under the terms of the tax treaty. However, it cannot be assumed that this will always be the case. The relevant treaty and/or the foreign tax authority concerned should be consulted. Many tax authorities, including HMRC in the UK, require a specific claim to be made for treaty relief, and this is usually obtained by the employee filing a tax return. Most employers will assist their employees with the completion of a return and any other paperwork necessary where double taxation will apply. Normally, the employee will ultimately pay the higher of the tax rates in the two countries concerned. For example, earnings taxed in a foreign country with a 40% tax rate on a UK resident employee whose highest rate of UK income tax is the basic rate of 20% will be taxed overall at 40%. So 40% tax will be payable in the overseas country with no tax being payable in the UK. There could be situations where a person is resident in both the UK and the foreign country under domestic law, and the treaty will contain a tiebreaker clause to decide which of the countries will be their residence for the purposes of the provisions of the treaty. Being resident for tax purposes determines the amount of tax that an individual has to pay, either in the UK, overseas, or in some cases both. Employers will generally need to reassure employees that they will be no worse off by spending time overseas, and there are various ways in which this can be done. They can agree to pay salary net or gross, do hypothetical tax calculations, tax equalisation. Clearly, the impact of this will depend upon the extent of UK employees being utilised overseas. If the company is looking at one senior employee for a short period being overseas whilst getting things off the ground, it will be less important than to a larger organisation with a globally mobile workforce. However, particularly where there is any scale involved, it will be important to quantify the real cost to the business of employing UK individuals overseas. The company should also consider social security and the impact on pension contributions or other incentive arrangements of the employees being seconded abroad. Now turning to looking at using host country employees. Employers will need to ensure that the contracts that they're giving to overseas workers will not conflict with mandatory local legislation. It's generally recommended for contracts to be checked by a lawyer practicing in the jurisdiction concerned. Understanding local social security will also be vitally important. In some European countries, for example, the obligation for employers could be 2 or 3 times higher than that of the UK. Many jurisdictions will also have greater other forms of workers' rights, such as maternity, sick leave, and redundancy. Employer costs, which are significantly higher than in the UK, could have a significant impact on margins. So understanding the true costs will be vital to the success of the overseas venture. Now moving on to look at finance and cash management. Financing, particularly in the case of an overseas subsidiary, will be an area which requires consideration. Let's go back to the original example we'd looked at in webinar 1 of UK Limited. If we fast forward 2 years, in addition to a thriving business in country 1, they've now started to trade in country 3, and in this case for commercial reasons have incorporated a subsidiary in country 3. Cash flow forecasts for the subsidiary show that it will not be profitable for the first 12 months and therefore will require funding. UK Limited does have funds available internally to fund venture, so they won't need to resort to third party for funding. But the first decision will be whether for UK Limited to use debt or equity funding. In our example, given the short-term nature of the funding requirement, UK Limited decides to make a loan to the Country 3 subsidiary. Funding transactions will fall within the scope of UK transfer pricing legislation, so UK Limited will need to consider whether it is necessary to charge interest on the loan. If UK Limited is a small company and the UK transfer pricing exemption will apply, then they could decide to make the loan interest-free. If UK Limited were a medium-sized company, then the SME exemption would apply in the first instance. However, they would need to consider that HMRC could issue a transfer pricing notice and direct it to charge interest on the loan. If interest is going to be charged on the loan, then there are a number of issues to consider. So what interest rate should be applied? Should it be an arm's length rate? And what is the applicable arm's length rate? Will the subsidiary in Country 3 be in a position to obtain a tax deduction for any interest paid? And finally, will the subsidiary be required to deduct withholding tax from the interest payment? The alternative to loan funding would be the use of equity. However, in most cases, UK Limited is unlikely to want to tie up large amounts of capital in the subsidiary. The debt versus equity consideration would be more important if UK Limited looked to acquire an existing business in the overseas country, as opposed to establish a business there from scratch, because then the efficiency of interest versus dividend would need to be considered. The ultimate aim of the overseas subsidiary will be to generate profits to repatriate to the UK holding company. Although the UK would receive some funds from Country 3 subsidiary by way of intra-company transactions and transfer pricing, repayment of any initial loan financing. But once the entity becomes more profitable, we'll also be looking at making dividend payments to UK Limited. Dividends received by UK companies are taxable unless they fall within a specific exemption, and this will be the case whether they're paid by a UK or an overseas company. The rules are contained within Part 9A of CTA 2009 and are quite complicated. However, genuine dividends from wholly owned subsidiaries, such as in the example we've been looking at here, will fall within one of the exemptions. However, it is important to note that if UK Limited is a small company, then the dividend will only be exempt from UK corporation tax if Country 3 is in a territory with which the UK has a double tax treaty with a non-discrimination clause. So we've looked at the taxability in the UK of a dividend. It will also be important to consider the withholding tax position in the overseas country. In our example, Country 3 usually withholds tax on dividend payments, but the withholding rate is reduced to nil under the terms of the UK and Country 3 double tax treaty. Often where treaty relief is available, it will be important to sort out the documentation to claim the relief in advance. However, subject to that, then the exemption will be available. Finally, when dealing with overseas customers, the business will necessarily be exposed to foreign currency risk. Banking arrangements and accounting in different currencies will all need to be considered. There will also with potential for foreign currency gains and losses to arise for tax purposes. Foreign exchange differences will arise where the accounts of a branch are consolidated with those of the UK company and where no election has been made to exempt the branch from UK tax. And this is because for UK corporation tax purposes, the profits of a UK company, including those arising from an overseas branch or PE, must be computed and expressed in sterling. Exchange differences can also arise at an accounting period end, where there is a difference between the valuation of monetary assets and liabilities at the year end from when they were entered into the books. The general rule is that exchange gains and losses are included in calculating profits under the loan relationship rules. The detail of these rules is outside of the scope for today, but I just wanted to touch on foreign currency and exchange issues to make you aware of the position. So that's the end of today's webinar. Thank you for joining me. I hope that you have found this useful and will join us again for future webinars. The broad area of trading and profit management, there could be many